Accounts receivable. Accounts receivable are amounts due from customers from credit sales. When we sell $10,000 to customer Daniel on credit, we debit accounts receivable, then credit sales, which is revenue account. Customer Daniel will be part of sub-ledgers list. When customer Daniel pays, we debit bank, then credit accounts receivable. If customers do not pay us, then we create a bad debt. This are amounts which we cannot collect. When we use direct right of method, we debit bad debt expense, credit accounts receivable. If later on, we are able to collect $420 from customer Brian, we reverse the entry we made, credit bad debt expense, debit accounts receivable. Allowance method. The allowance method matches estimated loss from accounts receivable. At this point, we think we will not be able to collect, but we are not sure 100%. For example, customer tech has $200 sales on credit. We estimate 2% of it, which equal to $4,000, will be uncollectible. We debit bad debts for $4,000, credit allowance for doubtful accounts $4,000. The allowance for doubtful accounts is a contra asset account. It is placed under accounts receivable in the balance sheet. When we are sure that this customer will not be collected, we debit allowance for doubtful accounts and credit accounts receivable. Notes receivable. A note receivable is promissory note in writing, then we will receive some amount from someone on certain future date. A note receivable might be associated with interest. For example, Jane promises to pay $1,000 after 9 months with 1% interest per month. Initially, we debit note receivable for $1,000, then credit sales for $1,000. For the interest received the first month, we debit cash, $10, then credit interest revenue $10.